Good morning, ladies and gentlemen. Thank you for waiting and welcome to the conference call on the half-year results 2017 of the Volksbank, hosted by Mr. Maurice Oostendorp, CEO of the Volksbank. At this moment, all participants are in listen-only mode. After the presentation, there will be an opportunity to ask questions. I would now like to hand over the conference call to Mr. Maurice Oostendorp. Go ahead, please, sir.
Thank you very much. Also from my side, but also from on behalf of Annemiek van Melick, our CFO, welcome to this conference call. We've posted the first half results this morning, and I would like to start by saying that we think that the Volksbank is in good shape in terms of financial resilience and results, and also in terms of commercial results. We see a continued focus on our shared value approach, which starts to yield good results. Again, a net growth of the number of clients, but even more important, an improvement of the customer-weighted net promoter score, client satisfaction levels. We have announced today a collaboration agreement with Pivotus, a Silicon Valley-based fintech company. I will say a few more things about that, but it's focused on delivering on our mission of banking with the human touch. In terms of shareholder value, our financial results are sound. Annemiek will come back to that much more in detail in the second half of our presentation. I would like to take you through the three strategic priorities, starting with the strengthening of our social identity. We've labeled that as reversing the banking model, starting from the needs of our clients and processing along those lines. We will start a pilot that will empower our customer advisors to accept in direct contact with clients the mortgages. And we have clearly defined a policy that sets the boundaries for discussions with our clients regarding the repayment of their mortgages. We aim to agree on reasonable repayment terms that offer customers a perspective to obtain or maintain a healthy financial balance. And we've mentioned this before, we no longer transfer cases to debt collecting agencies. We have made preparations for the introduction of PSD2 in early 2018. In line with those preparations, we've defined a clear policy on data that belong to clients, the privacy rules along client data. And those rules are based on very simple principles. We assume the data that we have of clients as not our data, but they are owned by our clients, which means that we don't take commercial initiatives, we don't sell individual or aggregated data to third parties, and we want to help and inform our clients about the possibilities and risks of sharing their data with third parties. So a clear statement of policy in this respect. Another key performance indicator is our climate neutral balance by 2030. By then we want to have a 100% climate neutral balance sheet. And at the end of June this year we stand at 25%. The progress was mainly caused by an increase in sustainable project finance and investments in green bonds. The big delta in terms of climate neutrality will come from improving the energy labels of our mortgage portfolio. For that, of course, we need to have a dialogue with our clients because they need to take initiatives in this respect as well. And we offer different ways of advice to clients. Every brand has a different way to deal with that. in order to assist them in improving the energy levels of their housing. Our strategic priority number 2 is simplifying and enhancing the efficiency of our operations. In the first half of this year, we've made good progress on initiatives to improve and monitor that efficiency. They comprise straight-through processing, increased digitalization, optimization of support functions, further automation of IT processes, and a moderation of our remuneration policy. We have decided that as of this year, variable payments are bonuses, so to say, are not part of our remuneration policy anymore, which is not only a measure to manage the cost related to staff, but it's primarily done because we believe that variable bonuses are not in line with banking with the human touch. The number of jobs is expected to be reduced over the coming years by 800-900 people, and in line with this development, we have decided to simplify the top management structure, and this will lead to a reduction of senior management positions from currently roughly 47 to approximately 30 in the period up to 2020. In the area of simplification of our products, we introduced Doelbeleggen, a clear-cut investment account with support tools, allowing customers to invest independently online in one of the 5 sustainable mixed investment funds of our brand ASN Bank. Third priority is innovating as a smart adapter. In April this year, we joined the 3 other Dutch banks in the initiative to launch Payconic in the Netherlands. Payconic makes executing payments simpler, instantly I would say, and the association between Payconic and the banks anticipates the introduction of the Payment Services Directive 2, which, as you know, is a European directive. We introduced today a collaboration agreement with Pivotus. Pivotus is a innovation daughter company based in Silicon Valley, daughter company of Umka Bank in the USA. Together with Umka Bank, Nationwide from the UK, Credit Union, Australia, and the Volksbank, we share, first of all, the same vision on innovation, looking at what clients expect from banks, based on creating trust and connecting people. And the first result of this collaboration agreement will be a platform that allows clients to interact with a by them selected person within the bank for all their financial questions. In this collaboration agreement, we of course share the cost with other banks, but as we all have this similar philosophy on how we think we need to interact with our clients, we can also share the experiences from different banks in introducing these new innovations. And after the initial launch of the platform, which will focus primarily on a tool to communicate with the bank, we will jointly work on further innovations, and we really look forward to the international way of collaboration with these 4 banks going forward. And finally, with regard to simplicity and efficiency, we started initiatives to further automate mortgage and payment processes based on machine learning. It will never be the computer that says no, but the computer will assist underlying decision-making processes of staff of the bank. We've made good progress on basically all our long-term objectives, and I will say a few things about them. First of all, the overall customer satisfaction level developed well. I would say already for the 5th year in a row, we have seen a further improvement of the weighted average. It stands as per the end of the first half of this year at -4. Two of our brands have reached a positive NPS, which in itself is a good success because the positive NPS is still rare. And the two other brands, SNS and BOG Wonen, have seen a further improvement. As you know, our overall long-term objective is to have a weighted average which is positive, with a positive score, if possible, of all the brands. The customer growth is driven by the increase in current accounts. On a gross basis, we've again seen 99,000 new customers in the first half of this year. The net growth, though, was substantially lower as a result of the absence of major marketing campaigns, which are scheduled towards the second half of this year, and also an outflow of customers following the termination of the Zwitserleven Bank proposition that we had in the market. As far as current account customers, we've seen a continued good growth. 42,000 new current account customers, which represents 20% of, which represents a market share of 20% in the opening of new current accounts in the Netherlands, substantially higher than our market share on a portfolio basis, which stands at almost 8%. But we do see this increase as a reflection of the fact that people who do not bank with one of the brands of the Volksbank are attracted to the way we try to bank with the human touch. I think it's fair to say that the strongest point in our developments in the first half of this year are the strong growth in the new retail mortgage production. We have, again, also for the 5th year in a row, seen a further increase in the new retail mortgage production, which now stands at 6.8%. And on a total portfolio basis, our market share in retail mortgage loans is now virtually stable at 6.7. Our objective is to continue a growth in this market. The market share retail savings is roughly stable at 10.7. The retail savings balances, despite the low interest rate environment in Europe, increased to 37.4 billion. So the low interest rate does not seriously impact the level of retail savings balances in Holland. One more thing about that mortgage production, that outpaced the level of redemptions. The level of redemptions is still substantial. Many people move from one house to the other, and in that respect it's important that we not only focus on new clients, but that we also pay attention to existing clients who decide to move from one house to another, and selecting us to finance their new house as well. But still the level of redemptions is high, but we're pleased that we have been able to see the portfolio grow by 400 million, which we believe is in absolute terms, but certainly also in relative terms, one of the strongest growth in the Dutch market. I would like to hand over to Annemiek, who will tell you more about the financial results and the outlook. Annemiek.
Thank you, Maurice. I think in general we've had a relatively strong H1 financially. If we look at net profit, it was virtually stable at 177 million euros compared to the first half of last year, and it was an increase compared to the second half of last year. If we look at the adjusted net result, whereby we adjust the figures for the fair value movements in DBV and for the large restructuring provision that we took last year, we see a slight decrease versus the first half of last year, which is predominantly related to the lower release of provisioning. Last year we had 45 million, this year we had the first half of this year we had 20 million. which is the key indicator of a slightly lower adjusted net result first half this year versus last year. If you would compare it with H2, we see an increase from 161 million to 178, and that's predominantly being caused by a net interest income margin that increased back to levels where we were in the first half of last year. With the 178 million, we produce a solid ROE of 10% despite the current high quarter one capital ratio and high leverage ratio. If we look at the income, it's a similar picture towards the net result. We do see a slight decrease if you look at the adjusted total income, where we have adjusted for the fair value movement in DBV. We see a slight decrease versus the first half of last year, and we see an increase versus the second half of last year. For us, quite important, the NIM, net interest margin, held up pretty well. It went back up to 150 basis points, despite the decreasing income that we see on mortgages, which is obviously caused by the lower interest rates on mortgages that we currently offer, and that especially have come into our books related to the renewals of the vintage in our book, which comprise a large part of our book, which was originated between 2005 and 2007, predominantly in 10 years, which have all come to renewals in the last 3 years, including the efforts that we make in terms of retention to reach out to our clients, specifically at the SNS brand, and since this year also specifically at the BLG brand, to contact our clients proactively if it makes sense for them to look at an early renewal of their mortgage. By now, around 75% of our mortgage book has renewed to the low interest rate. We actually do see the pace of early renewals slowing down a little bit. We had 3.1 billion of total renewals in the first half of this year, of which around 40% was early renewal, and that corresponds to close to 5 billion of total renewals in the first half of last year, which consisted for 50% of early renewals. So we do see the pace coming down there a bit. It does have an impact on the interest income we got on mortgages, but we also managed that way to keep the retention at a relatively good level and prevent more redemptions out of our mortgage book, which we would in that case have to renew with new production, which would also have been done at low levels. So we're pretty satisfied with the NIM where it came out for the first half of this year. If we look at the operating expenses, we see a decline there. If we look at the adjusted operating expenses, where we've adjusted for regulatory levies, which were broadly in line with the first half of last year, and if you look at the second half of last year, we also adjusted for the large restructuring charge that we took there. We see a decrease in adjusted operating expenses by 5% versus the first half of last year, 3% versus the second half of last year, predominantly related to less expenses that we've made for marketing, less expenses that we've made for consulting costs, which also corresponded to a lower cost-income ratio. If we look at the cost-income ratio where we have adjusted for incidental items and regulatory levies, we see a cost-income ratio of 52.5%, which is down from the 54.2% that it was last year. That decrease is entirely due to the decrease in operational expenses. If we compare it to the second half of last year, where it's at 62.6%, we also clearly see the impact of improved total income versus the second half of last year in there. We do expect that the second half of this year will not be a continuation of the decrease in adjusted operating expenses, given that we will have some costs for strategic projects and we'll have some more costs for marketing expenses, but by and large over the total year we do expect to show a decrease in cost versus the total year that we had last year. If you look at the FTE figures, we did see a decline there of 44. The decline in internal FTE was a bit higher, it was 66, but that was partly compensated by 20 increase in FTE which was predominantly related to some activities that we're doing in the field of transaction monitoring. If you look at the loan provisions, we again did see a release there, the release of 20 million versus 45 million in the last year. Corresponds to a further reduction that we see in loans in arrears from 682 million to 527 million. The current loans in arrears of our total book is now 1.2%. If we look at the default book, that's 0.7%. We do see the pace of releases of provisioning slowing down, and we expect that slowdown to continue in the second half of next year. If you look at the average LTV of the book, it's obviously been helped by the increase in house prices that we have continued to see. So the average LTV, where it stood last year at 82%, actually came down to 77% at this point in time. We did see a further improvement in our capital ratio. Our core Tier 1 improved from 29.2 to 32.6%, which was predominantly related to the decrease in RWA that we saw from last year, from the end of 2016, 15% to 13.5% at this point in time, and some increase in our core Tier 1 capital. Our leverage ratio is 5.5%, and our MREL is currently at 6.3% if we exclude senior unsecured. We have a target there of 8.5%, so that leads to roughly slightly over 1 billion that we would have to issue in terms of senior resolution notes to reach our target of 8.5%. We're still awaiting clarity on the regulation there before we will start issuing those notes. Our internal capital target is still 15% core Tier 1 and the leverage ratio of 4.25%. We clearly have more capital at this point in time than is our internal target. And if we look at some of the impacts ahead that will impact our capital requirement, which are based on regulations or on supervisory discussions, which we've displayed on the next page, we will mention a few. We are in discussion with the ECB on preliminary findings of a thematic review that they have done on our IRB model for mortgages. One of the conclusions of those preliminary findings is that that the ECB has the intention to apply a proportional conservative adjustment on the margin of conservatism in our model. It's still unclear what the timing will be of that and when it will come into effect. If it would come into effect, we would expect that to increase the RWA of our retail mortgages by approximately 1.5%. In addition, we are obviously, like all other banks, preparing for IFRS 9. The impact there is twofold at our bank. We still have a legacy portfolio from the insurance company called DBV, a portfolio of mortgages that we currently have at fair value at our balance sheet, as you know, which creates volatility through our P&L. And we will use the introduction of IFRS 9, which is an accounting change, as a way to actually transport that portfolio to amortized cost. That will have an impact. If we were to execute that today, the impact would be roughly 1.1% on our core Tier 1 ratio. And like other banks, we will obviously also see an impact through our expected credit loss and through our provisioning for that due to IFRS 9. At this point in time, we would expect that to be roughly 30 or somewhere around 30 basis points. It's still an early indication, things may change, but by and large we would expect from the transition of the DBV portfolio from fair value to amortized cost and the increase in provisions to have an impact on our core Tier 1 of roughly 1.4%. Now obviously the impact of IFRS 9 or the IRB model adjustment is relatively subdued if you would compare it to the impact that we'll ultimately get from Basel IV. Like the other banks, we still don't know when we will get final regulation there, and once we have a final agreement within Basel, it will still take a while before it's all transported into European legislation. But given the current capital position, it's fair to say that even if it would be implemented tomorrow and it would be done at a 75% floor and with all the regulations that have been provided by the BCB so far in notes to the GIOS, we would still have excess capital over our 15% Core Tier 1 target that we've set internally as a target. At this point in time, we have a shareholder that does not request to use even the full payout ratio that we have of our dividend, between 40 to 60%. The request for dividend that we get is still a bit below that 60%. Our shareholder is at this point in time not requesting us to release any further capital and has indicated that there is a stance to await further and final regulation on Basel IV before we will start discussions on the capital positioning of the bank going forward. Until that time, we will continue to add profit and we will continue to increase our capitalization further, but also maintain our internal target, which is set at 15% Core Tier 1. If we look at the funding and liquidity, there is not that much interesting stuff to mention. We still have a large liquidity position of slightly over 12 billion. Our loan to deposit is 103%. Over the last half year, we've done some issuance in the covered bond space and made use of the attractive spreads there at this point in time. And if we then look at what the outlook would be for the second half of the year, we do expect some more pressure on our net interest income, as we do expect the income generated on mortgages to remain relatively low. We do foresee that in terms of renewals to lower interest rates, we have had the bulk of it obviously past us now, but we do continue to see some more renewals coming ahead. On operating expenses, we would expect a slight increase versus the first half of this year, and in terms of retail mortgages and the provisioning for that, we still expect a slight further release, but that is expected to be lower than we've seen in the first half. All in all, if we would add it, we would still be confident to have a solid financial result for the full year in 2017. And then I hand back to Maurice.
Thank you, Annemiek. We scheduled an introduction to our results of 30 minutes. It's exactly 11:30, so we would like to open the floor for questions and we will try to answer them at our best possible.
Ladies and gentlemen, as said, we will start the question and answer session now. When you have a question, please press star 1. And your questions will be answered in the order that they are received. So star 1 for your question or remark. Go ahead, please. The first question is coming from Mr. Cor Kluis, ABN AMRO. Go ahead, please.
Good morning, Cor Kluis, ABN. Got a couple of questions. Maybe first on the net interest income. Could you elaborate a little bit about how it exactly works at Volksbank? Because each year we see that H2 is lower than the first half of the year. That was 2015-16 and also now in 2017. Why is that the case? Is there something specific to mention over there? And second question on the NII is, I read that you revised the prepayment model on mortgages, which increased the mortgage duration estimate. And you did some extra hedging that normally has some negative effect on the NII. When did you do the hedging and what kind of effect, or will it be material effect on the NII going forward? And the third question is about FTEs. So you mentioned 800 to 900 FTE reduction in the years ahead. Could you give somewhat more granularity about the pace of FTE reductions? Because in 2016 it was around 193 decline. Year to date it's 44 decline. Will it be 3 years, 6 years, 8 years? Could you give some indication about that and which fields that's going to be? Okay, thank you.
Thanks, Cor, for your questions. I still have to get used a bit that you say Cor Kluis from ABN AMRO.
No comment.
Let me get back to the first question on net interest income. Yeah, you would almost think that we indeed have something very weird in our net interest income, that the second half is always slightly lower than the first half, but that's not the case. The reason why it was that way last year is that given that we're a relatively simple bank, predominantly funded by by sight deposits. So a lowering of the sight deposits immediately has a relatively large impact. And what we saw in the second half of last year was a lowering of the rate, but that only took place in December last year. So that this year, the first full half, we still had the benefit of having lowered those sight deposits of most of the brands in December. Whereas in the second half of last year we didn't lower it for a while. So while we still had, due to the early renewals and due to the new production, we did see the lowering of the mortgage income coming in there. We didn't mitigate that by lowering the interest rate on our savings until December. So there is no structural element which would always explain a slightly lower net interest income in the second half of the year. It's more related to the pace in which we actually change the sight deposits. And that also relates to your second question, and the first half of this year, and that will also continue that effect in the second half of this year. The impact of additional hedging for the change in our prepayment model. We did make a behavioral prepayment model. The prepayment model is quite sensitive to obviously the interest rate view, but also to the number of housing transactions that we see in the general housing market in the Netherlands. It's contingent on long forecasts of the housing market, of the number of transactions and of the interest. What we see there is based on the current large amount of transactions that we've seen in a short period of time, but also on the interest rate expectations and the large number of renewals and resets of interest, regular resets that we've already seen in the book, that obviously the expectation of the prepayment rate by the introduction of this new model has come down. That had an impact on the actual duration of our mortgage book. And the duration of our mortgage book was lengthened by slightly over 0.7 in that regards, which led to a substantially higher increase in our total duration. Now we did steer that down. We obviously use swaps to steer that down, and we brought it back again during the course of the first half year to slightly over 1.9 in terms of duration of our total balance sheet. That did came at an expense, and we do see the full effect of those expenses also in the second half of this year. And to give some guidance there, that you could imagine that the expenses there for the full year of 2017 will be somewhere between 10 and 20 million.
Okay. Well, and probably for the large part, of course, it's the second half.
Yeah, but we introduced at the end of Q2, we introduced a prepayment model, but given that we obviously started doing parallel runs with the model during the course of the first half, we did already started hedging, and we didn't want to do all the hedges at one point in time, so we did already start doing the hedges in Q2 of this year. So part of that impact has actually already been taken in the first half, but not all of the impact.
Very clear.
If you look at the FTE reduction, last year we indeed communicated, and we repeat that this year, an anticipated reduction of between 8 to 900 FTE, which also includes management, and we expect to have that done by the end of 2020, where the bulk of it will be in 2019 and to a lesser extent in 2018. And we feel that reduction in FTE and the associated cost reduction related to that is necessary to in the current market of low interest rate, and with our business model to still continue to yield the return on equity that we have set as a target.
Okay, very clear. Thank you very much.
The next question comes from Mr. Robin van den Broek, Mediobanca. Go ahead, please.
Yes, good morning. Thank you for taking my question. I'm quite intrigued by your 8% return on equity target for 2020. For H1 17, but also for 16, you've reported a return on equity of 10% on a fairly high capital ratio. And I appreciate the moving factors you've pointed out on, I think it's slide 18. I was just wondering if we can get a little bit more detail on the moving parts. I guess Basel IV will be a big chunk. I think in the past you've always been quite outspoken on your expectations on risk densities for mortgages. So maybe we can get an update there and what kind of actual impact would you see on your quarter one ratio on the back of that. And a second big driver, I guess, is the normalization of cost of risk. But could you give us a guidance there? Because if I do some numbers and I would assume a 20 bps normalized cost of risk run rate, that would probably drag your return on equity down towards 6 to 7% return on equity. But then it still leaves quite a bit of extra capitalization in your quarter one ratio to basically withstand going to 8%. It seems like a big gap. So that's the first question. And the second question, which also ties into that, is on the NII trajectory. What's your view on volume versus margin going forward? Also the fact that I think deposit rates in the Netherlands are fairly low at the moment. I don't know where you are exactly. It seems that you're probably at a premium to the market. How much long do you expect to see more margin pressure going forward? That's basically it. Thank you.
In terms of your ROE question, I think the first answer to that question is that the Volksbank doesn't have a strategy to maximize ROE. If we would have a strategy to maximize ROE, we would probably have a higher ROE target. And I would envisage that even after the incorporation of Basel IV, you may actually, in good economic circumstances, end up with a slightly higher ROE target. We haven't disclosed the impact of Basel IV and the expectations of that on our quarter one ratio. So I won't give those numbers here, but it's clear that even if Basel IV would be incorporated tomorrow, based on the 75% floor, etc., and all the rumors that we've read around it now, we would still have excess capital over the 15% quarter one target that we have set. And we believe that even in Basel IV and with that 15% quarter one target, it would be fairly manageable through the cycle to obtain an 8% ROE. In terms of net interest income and our savings rates to that, our savings rate at this point in time for the main brands are anywhere between 20 and 30 bps. That is slightly higher than some of our peers. It's not because we need to offer slightly higher rates than our peers, because quite frankly we could actually lower the rates further without the expectation of seeing a substantial decrease of the amount of savings that we have. And if you look at our liquidity portfolio and if you look at the construction of the balance sheet, we would actually not mind from a pure financial point of view to have some less amount of savings there. But if we look at it from the shared value strategy that we have, we didn't feel that with a 10% return on equity generated over the first half of the year, it was necessary to further lower the savings rates and therefore the amount of money that our customers who have a savings account with us receive on that account any further. So it's a different way of thinking if you let go of the concept that you would maximize your return on equity.
Well, my question wasn't until on maximizing return on equity. You give a return on equity target, and I'm just wondering what the driving forces are behind getting to that target. So it's not about maximizing anything. It's about you giving a target, and I'm just asking what are the moving parts behind that. And the cost of risk through the cycle, could you comment on that, please?
Well, the 20% is relatively high that you use there. I would more think around 8 bips.
8 bips, okay. Thank you very much.
The next question is coming from Mr. Sami Adatia, Citibank London. Go ahead, please.
Hi, hello. So MREL, I understand you're waiting for clarity on regulation. So when do you think you'll be able to start issuing non-preferred senior bonds?
Well, that's a that's a very good question, and we would have hoped to be able to do it now or to do it somewhere in H2, but we still don't have any clarity on the Dutch regulation in that regard. And at this point in time, I'm not sure if we will actually get that clarity in this year. So we may actually have to postpone that to the beginning of next year.
And do you think, in a scenario this gets delayed further than you expect, do you think you'll issue more sub-debt, either in the form of additional Tier 1 or Tier 2?
Well, in terms of additional Tier 1, given the current core Tier 1 that we have, I don't think that's something that we would do until we have clarity also together with our shareholder on the complete capital structure and on the level of excess capital, etc. that's in there. So we still hope to be able to first do the senior resolution notes and then look at the other elements of the capital structure. And we hope that we would be able to do that beginning of next year, or if the regulation would actually be expedited a bit, still be able to do that on this side of Christmas.
No, that's useful. And I guess, given you've mentioned your shareholder, do you have an update on the government's current view on the ownership of the bank?
Well, at this point in time, they're pretty preoccupied with trying to get a new government in place in the Netherlands. And in our discussions with NLFI and with the government, it's our impression that they are not in a rush at all, that they would like to take the time, and that they are clearly monitoring our progress made. They will provide an update to Parliament shortly on where they stand on their thinking on us, and I don't expect anything there that would indicate an exit anytime soon.
That's very useful. Thank you.
The next question is coming from Mr. Matthias Dede, KBC Securities. Go ahead, please.
Hi, good morning. A few questions left from my side. First on Basel IV, if I could come back on that topic. Is there anything you can say on the mortgage risk weight based on that revised proposal which allows loan splitting? I'm not sure if you could say anything on that compared to the impact it would have relative to the previous proposal. And then secondly, on the mortgage book, you showed some growth in the first half. What should we expect going forward, considering that the housing market is exceptionally strong now, and that prepayments remain high and could remain high in case the housing market would slow down. So is it reasonable to expect growth going forward in the book, or should we more expect stability or even a decline? And then just lastly, on the cost income target of 50 to 52, could you just remind me whether that's based on stable, rising or declining revenues? That's not entirely clear to me. Thank you.
To start with your question on Basel IV, when we got the first proposals of Basel IV, I think it was 2 years ago, we indicated that at that point in time, when our original risk weight was actually still a bit higher than it was now, that could lead to doubling of risk weight in mortgages. If you look at the current proposal with loan splitting elements, etc. in there, we would expect the impact to be less than that, but still pretty significant for especially the Dutch market. Because despite the loan splitting, if you look at the LTVs in the Dutch market, the impact is still expected to be significant. If you look at the mortgage book and your question on that, it's we continue to see a very active housing market. You do see a bit of a division in the housing market, where in the larger cities we see the number of transactions leveling off a bit, simply because there is a shortage of supply of housing. In the more urban, in the more rural areas, in the periphery of the cities, we still see increases in the number of transactions occurring. We believe that the market for mortgages will continue to be very active this year and still also next year. And if we look at our own mortgage book there, we've clearly, after the nationalization, where we toned back quite a lot on the amount of, in the period leading up to the nationalization, in the amount of people and in the systems we had in terms of actually being able to administrate the new production and to handle all the requests for renewals, etc. We gradually built that up post-nationalization to do that in a controlled way. And we also gradually increased the share of all our labels. And if you look at the new production this year, you also see that there is quite a big chunk of new production going to Regiobank franchise, to BLG and to SNS, but also specifically to Regiobank and through BLG. There is still more capacity in our distribution channel to absorb a bit more of that market. So it's not a pricing question, it's also a question of what can you operationally cope with, and we're still working on operational efficiency to be able to handle more requests purely from a production point of view. So I think in a market that probably continues to remain active, although you may see a leveling off transactions given the shortage of supply, we would still be able to increase the amount of production a bit versus what we have seen now, and at least continue the growth of our mortgage book for the short period ahead. Whilst at the same time we will continue to focus on actually keeping retention as high as possible in our book. The cost-income ratio of 50 to 52% that we communicated last year was based on the expectation that where our net interest income was last year, that would actually decline slightly towards 2020. So the 50 to 52 cost-income ratio was based on a declining income level at the bank versus 2020.
Okay, that's very clear. If I could just briefly follow up on the comments on the risk weights. Have you taken into account the further decrease in loan to values in that guidance for a less than double increase? And is that when you mentioned that you expected the risk weight to double, could you remind me what the original risk weights were at the time of the initial guidance? Or the risk density?
Yeah, by that time they were, I believe, around 15 they were around 16 or so. And we applied that specifically to our mortgage book, which was also 2 years ago. And then if you look at our mortgage book now, it has obviously also improved quality-wise. And we now have a bit more guidance on the actual interpretation of the rules. What is still unclear is the actual level of documentation and administration and everything you need to have readily available on that mortgage to be able to treat it and get the release that you have if it's adjacent to if it's correlated to a lower LTV. So we'll see where that ends. But the loan splitting will provide some relief. Having said that, it's still a material impact for Dutch mortgages and also for our bank.
Okay, very clear. Thanks a lot.
The next question comes from Mr. Marcel Hoppen, Credit Suisse. Go ahead, please.
Good morning. Thank you for taking the questions. The first two are on slide 18. If I look at the IRB model adjustment, was it more of a sector exercise or is it more just specific for Volksbank? Could you just elaborate a little bit more on that? The second one is on the IFRS 9, the mortgage from the BV. Could you just explain to me a little bit why there's a decrease on the capital position because of that? The second one is on the mortgages, particularly on the margins. How do you see the front book and back book margin developing a little bit? Are the front book margins still higher, as you have earlier indicated, or is it leveling off a little bit? And how does it compare to or connect to the NII expectation for 2017? The last question is on the more of domestic demand for SMEs and consumer lending. The total volumes for both books has declined the last couple of years. How do you expect that going forward? Is there demand at all, or is it a particular sector you're not interested in, or just a little bit more color on that would be much appreciated. Thank you.
On your question related to the IRB adjustment, The proportional conservative adjustment to the MOC is SNS, or as the Volksbank, specific. The reviews that have been done are both specific but also general, because there is a thematic review on the IRB models being done by the European Central Bank at the moment, the TRIM exercise. When we received permission in 2014 from the ECB to use the internal rate, an updated internal rate model for mortgages, and that permission was granted under the condition to prepare a new margin of conservatism framework. We submitted that margin of conservatism framework in December, and in July we received some preliminary findings both on that margin of conservatism framework, but also findings related to the thematic review on modeling, which included this model as well. And based on those findings, which we are currently discussing with the ECB both content-wise and timing-wise, the ECB has announced its intention to give a proportional conservative adjustment on that MOC, which we will get somewhere during the second half of this year.
Sorry, quick follow-up. Will that be reversed going forward?
It is a temporary adjustment until the findings have been solved.
Okay, thanks.
If you then look at your question related to IFRS, I didn't specifically get it. Was it related to the increase in provisions, or?
No, so the reclassification of the DBV mortgages from fair value to amortized cost, I didn't quite understand why there would be an impact on the capital because of that.
Well, because if we change it to the, if we use the accounting trigger to change it from fair value to amortized cost, any differences between the fair value method and the amortized cost method, you will have to take, you will have to go through equity, which will be the case here as well, and which at this point in time leads to a decrease of 1.1% in the Core Tier 1 ratio. It's roughly in line with what we disclose in our annual report over 2016, where it was the first disclosure that we gave on this. From the top of my head, I thought it was around 100 million of capital impact, 102 million, I believe. And in the annual report, we also disclose what the factors are that are driving, what are the key drivers for that impact. In terms of margins of the mortgage book, we don't give specific comments on commercial margins there. But if you look at a 10H NHG mortgage, for instance, now is around 170 basis points. If you would compare that with a 10-year swap, which is around 80 basis points, you would have a spread of around 90 basis points, which is new production, but also roughly what you would see on the current book in terms of general spread. And then you had a question related to both the consumer and the SME book. In terms of consumer lending, we're not actively selling consumer credits anymore. And in terms of SME, we have a policy of SME loans that are over 1 million to run that book down. It was also one of the agreements we had with the European Commission by the time we were nationalized. It was one of the remedies. So we didn't actively pursue the over 1 million SME market further. On the below 1 million SME market, we are active, but only in a way where it can be treated as basically a retail customer. So what we do there in the fields of SME is if it's an SME loan, for instance, of a bakery shop or something, where someone actually has the shop adjacent to the house that he lives in, and it's kind of dual use. And so far we have not proactively pursued any growth in that segment. We won't exclude that for the future, but for now it has not been a strategic priority.
Okay, thank you.
The next question comes from Ms. Rosine van Velsen, ING. Go ahead, please. Ms. van Velsen, your line is open. Go ahead, please.
Okay, sorry. Most of the questions have been answered, but there has not been one answer yet on the first strategic priority. So I thought it might be interesting to hear some more on your target for a 35% climate neutral balance sheet in 2030. How do you expect to reach that target, or 100% in 2030? And maybe do you have an example of corporate initiatives within the Volksbank, for example?
Well, as a CFO, I still have to get used a bit to those climate neutral targets, and both the CEO and I looked at each other and who's going to answer that question. But as you can imagine, but it is a very serious target, where we actually build on the knowledge and the strength there that the ASN Bank, which is one of our brands, has contributed to the Volksbank. And in order for us to become completely climate neutral, and we calculate that, and on our website you can actually find the calculations that we have behind that, we basically construct a sort of P&L based out of all our assets, which measures the CO2 level of reduction and emission, and that is ought to be neutral in 2030. Now, there are things that we can do by investing in green bonds. ASN has various own loans granted to very sustainable projects like windmill parks and stuff like that. But that doesn't ultimately lead to a climate neutral balance. What is essential for that is that we increase the sustainability level of the mortgages that are underlying, of the houses that are underlying our mortgage book. Now, at the moment, the average energy label there is D, and in order to become fully climate neutral, that average label, energy label, adjacent to the mortgages, should increase to B. If it increases to B, and if we at the same time invest in green bonds, and all the other asset categories of the balance are, as we describe in a paper on the website, in a climate neutral way, then that will be sufficient to become climate neutral. Now, it's going to be extremely hard to actually get all those energy labels from D to B. And a very easy way would be to say you would only produce new build mortgages for new build houses, because typically they are A or B. But in terms of what climate experts say there is that the bigger climate impact you would actually reach by converting the low-level energy labels into higher labels. Now, there are a lot of people who have a preliminary energy label and who don't have a permanent energy label yet. So one of the tasks that we've set and that we've also asked our brands to do is to get clients to look at conversion and actually converting their preliminary energy label to a final energy label. And we try to help clients there with initiatives to actually include or improve that energy label, and it differs a bit per brand on what they actually do there. What the BLG brand has done is that they have offered all their clients a thermal heat picture associated with a collective offer to improve the isolation of the houses that are underlying their book. Regio Bank has actually offered clients help in getting a permanent energy label rather than a preliminary energy label. And SNS advisors, when they are discussing a mortgage with their clients, they at a attractively priced level offer a energy savings report, which contains lots of measures. Now, we've done various other pilots, and what we basically find out there, and we've reached out to over 300,000 clients with a specific offer to either rent or to buy or to participate in solar panels on their house. Now, we see that around 3,000 of those clients have reacted and have actually used that offer. One of the next offers that we'll do is to do a collective offer of isolation for houses and also send that out to all of our clients. So the key to success, what all the experts in this field tell us, is not to just convince people or give them a discount on a mortgage if they buy an A or a B label house, but to actually go a bit further in what you offer them and make it very easy for people to either see at one point what are the biggest energy savers that I can do for my house and offer them a discount, or try to organize it for them so that they can easily participate in initiatives that will lead to an improve of their energy label. So it's a kind of multi-option approach that we use there, and we're piloting what is the best use and how can we actually increase that energy label of the underlying mortgages to an average label that is higher than, or that is B or higher in 2030, because that's going to be crucial to become climate neutral. And it's a whole new KPI that we still have to get used to, broader than just ASN.
Maybe just a small follow-up then. And are you willing to do investments or trade off some of your other targets for this target?
We have already done so, because we actually and we have made costs to actually facilitate these pilots, and we've also made costs to offer clients to give clients an offer to participate in these solar panels or to participate in the collective isolation. So there is a cost associated with it, definitely.
Mm-hmm. Fully understand. Thank you.
Ladies and gentlemen, for any additional question or remark, please press star 1. Star 1 for your question or remark. No further questions. Please continue.
Okay, thank you very much. I've really appreciated listening in to the Q&A session with Annemiek. If you might have any further questions, please, you know that our Investor Relations Department is available for that. Let me finalize this conference call by saying that we are pleased with the developments the bank has shown, and we hope to continue them in the near future and longer future. Thank you very much for calling in, and have a nice day. Bye bye.